Good afternoon, everyone. Thank you for coming to our program. My name is Daniel LeBay. I'm a partner in the Capital Markets and M&A practice group at Vincent Elkins. I'd like to introduce the additional speakers here to begin. To my right, Chris Green, a fellow Capital Markets and M&A partner. Chris works in our DC office. George Howard, second from the end there, a partner in our firm's restructuring and reorganization team here in New York. Steve Abramowitz down on the end, also a partner on our firm's restructuring and reorganization team here in New York. Wally Schwartz, who is a partner on our real estate team here in New York. And then Paige Anderson will be subbing in for me during the program to cover some tax issues. She's a tax partner at the firm. So thank you all for joining us today. If you could advance to slide number 5, please. So I'd just like to set the stage here for sort of the program and the topic today. We were able to pull together some data, some market data regarding commercial mortgage debt that is outstanding. And this slide and the next sort of paint an interesting picture as you think about the environment that we're going into now. There's about $4.5 trillion of commercial mortgage debt outstanding in the United States right now. Approximately $2 trillion of that is going to be coming due, is going to be maturing in the next 2.5 years. About $400 billion of that debt is in the office sector, and over $100 billion of that debt sits on the balance sheets of public REITs. And when I say that, of all coming due in the next 2.5 years, really by the end of 2025. Rates have gone up about 600% in the last 2.5 years. And we are in an interesting sort of inflection point over the next coming months and years as huge amounts of debt coming due in an environment where rates are much higher, where lenders are tightening up on the extension of credit. If you look at the next slide, it shows kind of how that debt breaks down among different lenders. And you'll see a significant portion of that commercial real estate debt sits with regional banks and smaller banks around the country, many of which themselves are facing some distress and may not be as likely to refinance debt on favorable terms or at all. So that sort of sets the stage for an environment where a lot of real estate owners and operators who finance their assets with debt are going to be facing some interesting and tough decisions. And so we've assembled our group here to talk about how participants in the real estate industry can prepare for the coming, I won't call it a crisis, but the coming difficulty that these conditions create. I'd like to turn it over to Wally to talk a little bit about the real estate aspects of what we are facing.
Okay, so moving to the next slide on identifying distress. This fits in exactly with Daniel's scary charts that we just saw. And the first item in the first box is this, I think, the big elephant in the room that everybody has been reading about in the newspapers and everybody's worried about. That is the amount of debt that is maturing in the very near future. How much of that relates to the office space segment in commercial real estate, which seems to be the most distressed at this period of time. And as debt matures, what building owners are facing is, as Daniel pointed out, the cost of refinancing that mature debt has increased significantly since the time the existing debt was put in place. And then they are facing collateralizing that with properties that have lost significant value, especially, again, in the office space segment where vacancy rates are much lower, rents are lower, tenants are not paying rents, and then faced with an environment of trying to refinance in a marketplace that has many fewer potential lenders than it had when these properties were last financed. So all of those items are what is bringing us together here today to discuss what to do in these circumstances. Other financial indicators here relate to declining cash flow. And the last item on the left, potential covenant breaches, is something maybe not as big an elephant in the room as the debt maturity, but it's quite often are the things that most often trip up borrowers, which are technical covenant defaults that might relate to financial covenants, to debt service coverage ratio, milestones that may be required by the loan documents in terms of leasing or sales in connection with the properties that collateralize the loan. On the right-hand side, the operational indicators fall in line with that, with what I've just been talking about. One item to note, the item towards the bottom, Class A properties becoming Class B properties. I've had clients discuss with me, maybe the one saving grace area in office space seems to be Class A properties, which even in the tough markets like New York City seem to continue to be getting high rents. We know that personally because we're paying very high rents here as we expand our space here in the Grace Building. But what our clients have been telling us is that definition of Class A has become much more narrow than it used to be. So there's a Class A, and then there's a Class A that's actually moving towards being designated as B. Retail locations, on a personal anecdotal note, we've been seeing in our practice a lot more retail leasing activity than I ever would have expected this quickly after COVID. But the lease terms are much different in that they're mostly percentage rental payments as opposed to having the base minimum rents that we saw before COVID. The other thing I would just note here is last year, the real estate market was actually fairly robust, even as other parts of the economy were not so robust. And I think a lot of that related to what some people have called secular markets. That is, marketplaces that seem to have their own, because of being in areas that people were moving into in the post-COVID era. They seem to have their own set of financial aspects that were totally separate from the overall economy. And those hotspots around the country were thriving. Austin, Texas, West Palm Beach, Florida, Atlanta, Georgia, the West Coast. A lot of places that kept us busy. Last year was the first year that we did most of our work outside of the New York metropolitan area because we were following our clients to all those hotspots. But this year, I would say even those so-called secular markets are facing the headwinds of that the rest of the country has been facing and that the rest of the economy has been facing in terms of tough times for financing and refinancing.
Just before we go on, Wally, a couple of things here. I think a key theme we want folks to take away from this presentation today is runway. Time, giving yourself as much time as possible to fix, whatever issues. And this will dovetail on the next slide. Is that identifying if you're a company start to see some of these factors creep into your business, right? Identifying them early and figure out how you're going to message that or position that with your lenders as you approach maybe a maturity or have financial covenant issues you need to go address. I guess the counterpoint to that is, our experience is when you're a company borrower, you should be aware that other people are tracking these same metrics and are probably looking at the market and looking for opportunities to opportunistically buy at a low value or provide financing on, more aggressive terms than you might get from your bank lender are going to be tracking these same issues. And so I think all that dovetails into more of what we'll talk about today and some of what Wally will talk about on the next slide in terms of how do you identify this early and then best position yourself to try and fix it and tell the right story to address your upcoming debt maturities or get relief on financial covenant or other issues you might face.
So moving on to the next slide, which are some of the real estate solutions. Redevelopment, we have many clients who are repurposing buildings. They're taking old empty Sears buildings and turning them into medical care facilities. Our colleagues in the Dallas office have been very busy converting what used to be office space into residential space in downtown areas. So there's a redevelopment and repurposing of properties that's going on around the country. Lease renegotiation is a matter of a lot of companies and tenants downsizing, taking less space, making new deals for lower rent, or in some cases, some period of rent deferral. New debt and or equity financing. A lot of building owners and a lot of our clients looking for new JV partners to bring in new equity into their business. Sometimes that comes in as preferred equity or even as mezzanine debt. And the thing to look out for here is that quite often there are restrictions in existing loan documents as to transferring of interests in the borrower or transferring interest in the property, change of control restrictions. So there are a lot of things. In fact, with respect to all of these potential solutions, there are going to be possible provisions in the loan documents that need to be reviewed and taken into account as these things are pursued. Refinancing is sort of has the issues that I mentioned on the first slide. There are a lot fewer normal lenders, regular lenders out there. I'm told some of the insurance companies are still lending into the office market. And this has become a great opportunity for so-called alternative lenders. That is lenders other than the big banks and insurance companies and big institutions, being in some cases private equity. We just closed a loan for a client where the lender was one of the big real estate developers here in New York. So it has given the opportunity for different types of lending. Loan amendments, again, revising, trying to modify the items that might be covenants, that might be technical defaults, modifying milestones that might be in the loan documents, extending maturity dates and things like that. And then finally, sales. There are companies who will be raising cash by selling non-core or other assets to gain more cash.
Yeah, and I mean, Steve, you should comment on this too, but I think, where we often see, one, all these things take time, to go back to sort of the time theme, right? And also I think none of these are necessarily mutually exclusive, right? You probably very likely need to combine, for example, maybe redevelopment with some new debt or equity financing to achieve your redevelopment goals, right? And I think where we often see people get tripped up sometimes is not being super careful about what the restrictions are in the various debt documents that are already in place. And they do something that they think, they read it and they think, oh, clearly I can do this. And after they do it, they find out that the lenders disagree with how they read the lending document. And then you put yourself in a position where the lender has leverage over you. And frankly, obviously, lenders want to be careful, and I think monitoring if they have a troubled borrower, making sure the borrower isn't doing things right that aren't permitted or under the lending documents, or to have a voice to make sure that whatever plan the owner's putting into place actually makes sense, right? And is gonna end up with a property or a situation where the loan is going to get paid in refull or is best protected. So I don't know, Steve, if you have other comments.
Yeah, and you have to think about and one has to keep in mind, I mean, the entire capital structure is at issue. It's important to not say, okay, this loan has no covenants. I don't have a problem. I just got to deal with this lender. But you might find yourself that you have cross default issues. You got to think about and we'll talk a little bit about this, some non-obvious defaults that you might have to deal with up front, like the requirement to deliver not just a financial statement on a certain period of time, but a financial statement which doesn't have a going concern qualification. And that might require that you speak with, your auditors and you kind of be proactive on what they're going to require to give you that, proper opinion. And when we talk about loan amendments, there's obviously a large subset of that. Sometimes if time is not your friend, you might have to do very temporary, we'll talk about, forbearance agreements, agreements in which, the lender will maybe not waive a default then, but will agree not to exercise remedy. And to go back to what I first said, you always got to be very focused on, cross defaults. That might not just be, at the operating entity or the entity which owns the relevant property, but think about, your mezzanine loan documents. Think about, unsecured debt. Always keep in mind, are you keeping your vendors current? Could 3 vendors, cause you a problem if they got together and tried to file an involuntary? So your whole capital structure is risk. It's not just necessarily your main credit document.
Yeah, and I think it goes to the next slide, which we get to now, which is that you're going to, especially for public companies, have a number of opportunities to try and raise capital. And that all ties back to what's permitted or not permitted under your existing lending documents. And that all feeds together for a holistic analysis of what options you actually have on the table. So Chris, Dan, if you guys want to talk about for the public companies.
Right. So, Wally just covered some of the real estate solutions that might help alleviate a distressed situation, some of which involve generating cash. There are other methods, obviously, for public companies to raise cash through the capital markets. And I'm going to talk about a few of those. So there's really 3 different types of capital markets transactions that would be available to a public company that's in distress. The first is a registered offering, which would take the form of a marketed deal, a block trade with an investment bank, or an at-the-market offering. At-the-market offerings are commonly used by REITs, but probably not a great solution in this sort of a situation because it typically takes a long time to raise capital. You can't raise a significant amount of capital in a hurry through an at-the-market offering, so it's not a great option. Registered deals are attractive because they offer quick and easy access to the market. You can put together a prospectus pretty quickly and go to the market. The public nature of the deal avoids some of the shareholder approval requirements that apply to certain private deals. And these rules are governed by NASDAQ and the NYSE. But there's a few downsides, I think, really why registered deals don't make a ton of sense or don't tend to be the avenue of choice in a distressed situation. The first of which is there's significant pricing and execution risks involved. So obviously, once you announce your deal, you're also announcing, disclosing information about your distressed situation, how much capital you need, why you need it, et cetera. And at that point, you're really at the mercy of the market. They're going to drive, the market's typically going to drive a very steep discount on whatever security you're trying to offer. And so that's one problem. The second is in terms of once you've announced you're doing a public deal, you immediately have less flexibility. So even while the deal terms may be very untenable and you don't want to take them, once you've sort of announced that you're going to try and do a public deal, you really are going to have to probably follow through with the deal because announcing that you couldn't complete the deal is going to be viewed very negatively by the market. The second downside, I think, really is the question is, can you find a bank to actually underwrite the transaction, right? So investment committees are probably going to be pretty reluctant to approve deals for companies in distressed situations, not the least reason of which is, doing a public offering for a distressed company involves a great deal, just a lot more risk in terms of litigation on the backside. And a lot more risk, frankly, for the bank, who could do a pipe transaction and presumably have less risk. Rights offerings are another possibility. They're very uncommon here in the U.S. You see it more in Europe. And I won't spend a lot of time talking about rights offerings other than to say, there's a subscription period that typically runs 3 to 5 weeks. And so the question is do you really want to be in the public domain with these issues? And and uncertainty around how much actual capital you'll be able to raise through a rights offering. There's subscription risk involved with it. You just don't know whether existing stockholders will frankly be interested in helping you raise the amount of capital you need. And then finally, the last method, which seems to be the preferred method, which we'll talk a little bit about here, is a PIPE transaction. PIPEs are the preferred, I think the preferred capital markets transaction for one primary reason. One is they tend to offer speed. You can do these deals fairly quickly, depending on the structure of the transaction and what type of security you're offering. But the real key is they provide greater certainty of execution. So in a PIPE, you'll conduct a wall cross, typically to investors through a placement agent that you'll engage. Interested investors will sign an NDA with you, and then you'll proceed to negotiate a deal with them confidentially. Sign the purchase agreement, so you got the commitment, and then you announce the deal publicly. And so this facet of being able to obtain commitments in advance of a public announcement about something like this is obviously a very attractive piece to folks. There are downsides to all these transactions, frankly. So PIPEs typically involve a pretty steep discount to market price or a high coupon or other owners' deal terms. There may be governance deal terms involved. Somebody gets a director on the board or other accommodations. Also, depending on the size, as I mentioned before, anything that goes above 20% of the outstanding shares. So if you're issuing common stock or securities convertible into common stock in excess of 20% of the outstanding shares of the company, that would require shareholder approval under New York Stock Exchange and NASDAQ rules. Next slide. So just quick, PIPEs involve a number of different types of securities, including both debt and equity. And the type of security that is used, frankly, is likely to depend on the issuer, the nature of the distress, and the market environment. And so just a couple of quick points before I turn it over to Daniel to talk about some disclosure matters. One item is, as you look at the list of debt instruments, I would just note that most PIPEs that even involve a non-convertible debt instrument or non-convertible preferred, most of those deals wind up having some sort of equity sweetener, typically in the form of warrants. And so that's just to say that it's very difficult to avoid dilution in these transactions, almost unavoidable, I think. And then the second item is just to follow up on sort of the type of security will depend on the nature of the distress. If we looked at spring of 2020, what really happened were repo markets seized up as the economy shut down. Mortgage REITs in particular were sort of probably from a REIT perspective anyway in the most acute situation. But I think most of those mortgage REIT guys looked at the liquidity disruption really as temporary and substantially disconnected from their business or from the assets that they owned. And so what they were really looking for, needing, was bridge financing to sort of help get through this disruption. And so what you saw in 2020 was, instead of common stock PIPE deals, we saw a lot more non-convertible debt, non-convertible preferred, secured lending facilities, and typically all of those included warrants. So there was some dilution, but that's just the point about sort of how the nature of the distress will dictate what the transaction looks like. Daniel?
Can you go to the next slide, please? Next slide, please. So just following up on a couple of things that Chris said with respect to PIPE deals. So we're talking about, capital raising by public companies. And I think our audience today includes some public REITs, but there's a lot of other folks. So we'll try to get through the public company specific stuff fairly quickly over the next couple of minutes, and then get back to our real estate and restructuring colleagues. But just a couple of things to focus on here with respect to PIPE deals. Public companies are subject to Regulation FD. So Chris mentioned wall crossing, sort of the wall crossing process that is necessary when you're doing a PIPE deal. Because public companies generally cannot disclose material non-public information to investors without an NDA. And, there is material non-public information that comes into play when you're doing a pipe deal. Just the knowledge of the pipe deal itself can be deemed to be material non-public information. And in order to do the raise, typically the investor is going to need some information that hasn't yet been publicly disclosed necessarily regarding the company's current liquidity situation and outlook. The details around the negotiations that the issuer is probably engaging in with its lenders, and the status of those negotiations, including whether there are any defaults or events of default that have occurred or that may be pending, forbearance agreements, waivers, and other arrangements. All of that information is going to be important for a pipe investor to have. And so it's going to have to be disclosed under an NDA. And then you balance that against the fact that a lot of the typical investors who participate in pipe transactions as investors really don't want to be restricted with MNPI. And so that's one of the reasons that a pipe deal makes a lot of sense, because it can get done and sort of needs to get done very quickly. It's pretty common for investors that are looking at doing a pipe deal, when they enter into an NDA with a company in order to get the information they need to make the investment decision, will also include some sort of blowout or cleansing requirement in the NDA that requires the company to, publicly disclose the MNPI that's been provided to the investor within a specified period of time. So speed is really important in these deals. Just a couple of other points. A lot of the investors, not only do they not want to be restricted with MNPI, they also don't want to be deemed to be an affiliate of the company. And so for some companies that are in particular distress, where their stock price may be trading way down, the pipe deal may actually involve an issuance of a fairly substantial percentage of the company's ownership interests. But they don't want to be an affiliate because they don't want to be subject to Section 16, both the reporting requirements of Section 16 or the short swing profit requirements of Section 16B. And they don't want to be subject to the trading restrictions under Rule 144 that would apply to an affiliate. And one way to manage that is by including a blocker, an ownership blocker, in the documentation. So, for example, if a pipe investor is buying convertible notes, the conversion rights would be subject to a cap on their ownership of 9.99%. And one way to satisfy an issuance requirement to an investor, either a holder of a convertible security or an issuance of stock that might be due as part of a payment, maybe an amortization payment that's being made, is to, instead of issuing stock, to issue pre-funded penny warrants that themselves may have a similar 9.99% blocker in the warrants. You can go to the next slide, please. So these next couple of slides, I'm going to go through these pretty quickly. We just thought it was important to highlight some of the disclosure considerations and obligations that public companies have to be mindful of and really have to very carefully manage when they're in a distressed situation, particularly when they're trying to balance managing the distress that they've got with lenders with capital raising. Generally, a public company, I think you're all aware, they have to file reports with the SEC, 10Ks and 10Qs, and those filings have to include an MD&A. The MD&A becomes a critically important disclosure section in a 10Q or a 10K for a company that's experiencing distress. There's a section in the MD&A called liquidity and capital resources. And when a company is in distress, that becomes an intense focus for the market and for investors. That's a section that has to include very careful, accurate disclosure regarding not only the company's historical and existing financial condition, but also disclosure about uncertainties and trends that the company is facing that are likely to occur. That creates some tension for issuers, because on the one hand, they are sometimes desperately trying to raise capital to satisfy their funding requirements for their operations and their debt obligations. But at the same time, they have to file a 10K or a 10Q that includes disclosure, sometimes disclosure that is somewhat alarming regarding their liquidity position. And so there's a bit of a balancing act that companies need to manage their way through when they're drafting their Ks and their Qs and drafting their MD&As. Steve mentioned earlier the going concern analysis. So the auditors are likely to conduct a going concern to engage in going concern testing for a company when they are performing their audit or their review for a 10K or a 10Q. And that involves actually looking very carefully at what the company's liquidity position is and sort of testing whether the company has sufficient liquidity to fund its operations and satisfy its obligations during the next 12 months. If the company is unable to demonstrate that, they can get a going concern qualification in their audit opinion or in the review, and that could potentially be a default with respect to certain covenants that they might have with lenders, and also would just generally be deemed to be a red flag for the company, which puts additional pressure. Next slide, please. This and there's more detail about these disclosure obligations in the appendix. So I guess we don't want to spend too much time on this today. So I'm going to move quickly past this. The next slide is just sort of a quick summary of additional. The one right before this. Of additional disclosure obligations that public companies have. I'm not going to go through all of this. I'll just point out item 204 of Form 8K. That's one of the items under 8K that actually where an 8K, a current report gets triggered in certain cases. So if there's a default or an event of default with respect to one of the company's loans or credit facilities that triggers a remedy on the part of the lender that involves accelerating the debt, that actually triggers an immediate disclosure, within 4 business days disclosure requirement. And it's important, again, as Steve and George were saying before, to carefully review all of the company's loan documents, because one default may actually result in a cross default with other loan documents, and those all have to be disclosed as well. I think I'm gonna turn it over.
I just wanted to add quick on the going concern thing, right? Which is that being proactive in the process is obviously important, because I think from our experience, right, that the timing on the going concern opinion itself from the auditors can come up pretty quickly, right? I mean, it's going to get done every quarter effectively. And so, and it's a busy time, obviously. For accounting staff and financial reporting folks and legal and other, because you're trying to prepare your 10K or your 10Q. And so, it's just something it's something that can really, come up on you pretty quickly, I think.
It can. And when the deadline for filing a 10K or a 10Q is looming, that tends to be when a company that is facing a potential going concern qualification can really engage in some intense negotiating with its lenders, including, those tend to be, I've had some experiences in the last few quarters with some companies that were experiencing some distress where they can sort of use the leverage of a potential, sort of a looming potential going concern qualification to really pressure lenders to come to the table and negotiate a restructuring of loan terms, including in some cases exchanging equity for debt. I think I'm gonna switch with Paige now before my colleagues jump in. So thank you, guys.
I think we could probably
Keep going.
Yeah, let's go.
next slide. Chris, do you want to take the lead, or?
I'll lead us off, and then, so I think, this comes back to the theme of runway, liquidity, and understanding exactly how much time you have. I think it dovetails to what Dan and Chris were just talking about for public companies, in particular on the disclosure obligations, and how what disclosures you might have to make can impact your access to the capital markets and the transactions, including pipe transactions that Chris was talking about, right? Because it can impact share price. And then that can drive you to a solution. Sometimes it can provide the right conditions to get concessions from your lenders. Sometimes it puts your back up against the wall, and as a company, it forces you to give concessions to get what you need to get through a going concern, for example, or avoid a negative disclosure to, not have a cascade of negative consequences. So this slide here, we just tried to list out the key factors that drive and help a company, and frankly, a lender looking at a company, like how much time the company actually has, right, to figure out a solution if it's experiencing some level of distress. So obviously you have, how much cash you have on hand, how fast are you burning through it, right? And I'll tell you right there how much time you have to get something done. what are the restrictions in all of your debt and equity documents, which we referred to earlier about, how, can you raise secured debt? Can you not? Can it be unsecured? Is it capped, right? Can you do equity? Are there limitations like Dan was talking about, how much equity you can issue without running into considerations? Are there restrictions in your corporate documents with fellow members in an LLC about what you can or can't do? So understanding all of that helps you understand, again, what your picture is, what consents you might have to go get to pursue certain options. And then obviously the more consents, the longer it's probably going to take to get something done.
Yeah, I want to add also, there's going to be a big premium on the financial and accounting staff at this time. I mean, we talk about, how much cash, what's your burn rate? You're going to get questions. Your lenders are going to want certain formats. They're going to want what we call the 13-week cash flow is a common thing, probably more common in distress than in other situations. But lenders are going to want a lot of information very quickly. So just keep in mind that these times, you'll likely have other issues, but kind of the use of resources is going to be important.
Yeah, I think factored into that is an analysis of exactly, to the extent there may be a default under one of your lending documents, like what could a lender do and what are those defaults, right? And understanding very clearly, a lot of times companies will be like, oh, we've been doing this, we've done this 5 times, we never had an issue with our lenders, but get into a distress situation, the lender might look at the documents a little bit differently and decide that's not something that's permitted, and then use an actual or threatened or potential event of default for leverage. And then understanding what the lender could do with that. Can they take control of the company's cash? Can they sweep all the rents that are coming into the business? What are the things they can do that might really impact or sometimes even eliminate the company's flexibility to take various steps? And I think a part of that, Wally, you should talk to this too, but right, like lender dynamics can shift pretty dramatically when you get into a distressed situation. Instead of the relationship banker, all of a sudden the distressed team at a bank lender might get involved. And so all of a sudden the company's talking to a very different person with a very different perspective on the situation. Or, even sometimes, well, do you want to talk about special servicers that come in sometimes?
Yeah, so this one sort of cuts both ways, because on the one hand, you might be upset that you're losing that special long-term relationship that you've had with a certain banker who you've been working with, and you figure this is the person who's going to help you get through this distress. And then all of a sudden, as soon as you're in distress, you've got a special servicer who really doesn't care about you and is now beating you up. But on the other hand, you may be in circumstances like in a CMBS loan where nobody will talk to you unless and until you do have a special servicer. So there are there aren't many situations where we're advising real estate clients to stop making payments, especially our clients who are tenants. But there are situations where that's exactly what you might have to do, stop paying your mortgage payments. And again, it all depends what your ultimate goals are, but you may have to stop making payments in order to get a special servicer on the scene who then you have somebody to negotiate a deal with.
Yep. I think last point here is just if, for public companies in particular, whether it's debt or equity securities, those securities might start to trade hands. And all of a sudden you might have another player come in who's making a totally different play, right? Isn't looking just to get repaid, but rather is looking to make a profit on buying securities at a discount, and then something happened for them to trade up, or even looking to use the leverage in the capital structure to take an ownership stake in the business. And so you need to be mindful that those people can start to come out there, and they might, again, take a much more aggressive interpretation of various lending documents than had previously been sort of the operating rules for the company. And that can put pressure on the business and impact the ultimate runway.
Yeah, and it might not be just public. You got to keep in mind a lot of even private debt documents, although, there may be restrictions on the ability of the lender to assign the loan, you'll often see provisions that say so long as there's no default or event of default. So if there's a default out there, that may be a time that you'll find out you all of a sudden have a new face on the other side.
Let's go to the next slide. I don't think need to spend a time here, Steve, but you hit a couple of the highlights of some things that trip people up.
Yeah, no, this is we and some of these we touched on before, but keep in mind also, as George I think alluded to, in seeing if obviously you're going to scrutinize your loan document, try to see where the potential faults may lie, but as we've seen sometimes, especially when you have new lenders come in, they will look at transactions that you might have done several years later. And there's no like grace period or statute of limitations necessarily. They'll look and say, we think you shouldn't have done this, and we're going to call a default now. And that's, a bad position to be in, even if you disagree vehemently. So it's important to, to look at this thing. So just common defaults, obviously engage in a transaction prohibited by the loan documents, breaching, the various, covenants, milestones. As we said, failure to deliver a required item. There's no, people use the term often, technical. Oh, that's just a technical default. There's no such thing, frankly, as a technical default. If there's a default and a grace period, if there is one, passes, that will mature into an event of default. So, often again, that phrase technical default is almost not worthwhile. Defaults relate to previous representations. Often when you make a borrowing, not only when you do the loan, but every time you take an advance, you're going to have to, bring down the representations. Those representations may include things such as solvency, which again may be challenged in hindsight. There are, reserve requirements about replenishing reserves. And I know when cash is tight, that might be something that borrowers are reluctant to do. So again, the theme is kind of get a handle on these things earlier in your whole capital structure, particularly with respect to cross defaults, as well in advance as possible.
So I don't know, Walt, did you want to add anything about just like the unpermitted lease amendments and things specific to real estate companies that maybe you've seen people get tripped up on before?
Well, it's in the category of doing things that you're not allowed to do under the loan documents. And so there are borrower landlords who try to make deals with their tenants, and it may be that they're not allowed to do that without the lender consent. They try to make transfers. Again, they might have to go back for lender consent. They might try to use their reserves or contingencies or things like that. So yeah, all those things are in the documents. You have to know them.
Let's go to the next slide, please. I think then, okay, so what happens, right? You've run into some issue under your loan document, whether you agree with it or not, right? You kind of have to deal with your lenders all of a sudden. And typically to keep the lender from taking action, what you often enter into is the forbearance agreement, right? So we put down here just what are some common things to expect or that lenders might want to ask for. And I won't read every word on these slides, right? But increased financial reporting, so the lender has a better idea of what's going on in real time. Might add financial covenants so that if something happens to the business, there's a trigger for the forbearance to expire. A lot of times the lender might insist the company hire advisors to help the company through the situation. Could be in the executive suite, could be like a lease consultant, could be, it depends on the situation. On the flip side, they might insist that the company pay for the lender to hire advisors. And that, of course, can impact the company's liquidity runway and cash burn if all of a sudden you're paying for another set of professional advisors. Let's go to the next page. They can add things like milestones to get things done. Like it might be a milestone to complete a redevelopment project or achieve certain agreements, renegotiating leases. A lot of times they ask for a consent fee or have their own expenses paid, reaffirmation of the debt and what their security position is to sort of box the company in so you can't later try to challenge the amount, validity, or priority of their debt. And sometimes, to the extent there was flexibility on the lending documents to go raise debt or equity financing, a lot of times a lender might want to shut that off as part of forbearance so that they're firmly in control and they're the sole source of capital. And that obviously gives them more control over the situation. Paige, do you want to talk about how some of that impacts the tax consequences?
Yeah, I think that the tax consequences are important to think about or talk to your tax advisor about when negotiating a forbearance agreement or other debt modification, because even though no cash changes hands, there can be tax consequences to both the borrower and the lender. There's a set of Treasury regulations that are pretty specific in outlining how and when this occurs. Essentially, they'll say you're looking for whether there's been a significant modification of the loan, and the reason is that because it's a deemed debt for debt exchange. You treat it as a sale of the debt, and so A modification is defined very broadly. So it's any alteration to the legal rights or obligations of the parties, oral, written, or implied by conduct. So once you get into negotiating a forbearance or modification, in general terms, you may be in this tax modification area. Now, in order for there to be tax consequences, the modification has to be what's known as a significant modification. And the regulations provide for 5 specific scenarios in which you have a significant modification as well as a facts and circumstances analysis. Some that relate to what we just talked about on the past couple slides. Consent fee can result in a significant modification if it changes the yield on the debt instrument beyond a de minimis amount. Standstill agreements, depending on how they're drafted in the facts, can also be a significant modification. Good news, the regulations specifically state that in addition, deletion, or alteration to a customary accounting or financial covenant is not a significant modification. So, Wally mentioned earlier that, this may be a common breach that's not easily caught or not seen, but if you go to the lender and you rework that, that's not going to cause a significant modification. So why do we want to avoid a significant modification? Well, from the lender side, if the lender purchased the debt at a discount or otherwise has a lower basis in the debt, it can have taxable gain on this deemed exchange, even though there's no cash being received. Depending on the terms of the exchange too, the debtor can have COD income. Usually, if the debt is not publicly traded, you don't have COD income unless there's been a principal reduction. But publicly traded debt, it probably will have COD income. Realized I went right to the acronym there. COD income is cancellation of indebtedness income. It is taxable income without the corresponding receipt of cash. It can be excluded in certain circumstances, insolvency, bankruptcy. But an important point to remember here, and particularly relevant to real estate, where a lot of things are done in joint ventures or other partnership structures, the question becomes whether the individual partner who the income flows through to is insolvent or bankrupt, not the partnership itself. So you can have a distressed real estate venture, but still, if the partners themselves are doing okay, may not be able to take advantage of these exclusions. And then just briefly, we haven't gone a lot into REIT specifics yet in the REIT qualifications. We have some stuff in the back on that. But for REIT, you do not have to include COD in your gross income test, nor does it raise your distribution requirement.
Yeah, thanks, Paige. And I think that really just, at least in the restructuring world, hopefully you can understand from Paige's description that it really becomes a cross-disciplinary approach to the situation in general, right? Like everything we do, you have to check and make sure it's not going to generate tax consequences for somebody, right? We got to check with Dan about, what kind of disclosure obligations it might trigger and what that's going to do to the market. And then we talked to Chris about what that might do to the company's ability to do a PIPE transaction or a registered offering, right? And we're going to talk to Wally about Wally, how quickly can you get this redevelopment done, right? And how much cash you need to do it. And it all, and we're, kind of there helping everyone think through the timeline, how lenders are going to approach the situation and think about it, or how a distressed investor might think about it, to try and help manage expectations and get everybody to the right place, which is hopefully resolving the situation consensually and at the lowest possible cost. But it takes a lot of different disciplines, right, and factors to get there. I don't know, Paige, if you want.
Right. Yeah, absolutely. And, on the tax side, it's more than just telling you what the tax consequences are of what you're doing. Sometimes different modifications or different deals with your lender that may not be economically that different can have different tax consequences. So it can be helpful to try and optimize those from the outset.
Yeah. Let's go to the next slide. So a question I often get in the distress world is, a company says, all right, so I'm about to be in default. Like, what's the lender going to do about it? What are they going to do? What, are they going to foreclose on me? Come on. And so here are a couple of things that we worry about and look for. The first is that if the lender has account control agreements in place, essentially, has control over the bank accounts, what they might do in an event of default is just take the company's cash away. And then you're completely at the mercy of the lender, right? And another one that's more real estate specific is that sometimes, in the real estate world, there's an assignment of rent provision. So where all of a sudden, upon certain triggering events, all that rent that you were collecting as the company or the borrower, all of a sudden is diverted directly to your lender. And so your cash flow is gone. And again, then you have no runway, right? And so I think that's part of the reason to be proactive here and really be thoughtful about what your documents say and what the restrictions are, and kind of adding an extra level of protection and thoughtfulness before you take certain steps, just to make sure you don't end up with one of these things happening. I don't know, Steve, if you have.
Yeah, I want to add another thing that's to keep in mind. There's been a developing area of law which basically sometimes enforces provisions in pledge agreements that say, these are stock pledge agreements, so these may be very relevant with mezzanine structures, but often the boilerplate pledge agreement has a provision that says, upon an event of default, the pledgee, i.e. the lender, shall have the right to, elect directors, because typically it's phrased in the way, until an event of default, the pledgor, has all the governance rights. But there are provisions, again, it's sometimes boilerplate, which no one ever thinks about. And, there have been situations where, pledgees of mezz debt have come in and like overnight said, there's a default, we've changed the board. So that's something, again, just be proactive with your documents and look at things like that. And it's because of things like the cash sweep issue that George, mentioned that could happen overnight, or these, aggressive enforcement of pledge agreements, while you really need something in place and not just trust that your lenders won't do anything, because they may have the right to cause, a catastrophic change.
Let's go to the next slide. So just, do you want to add anything on that, Wally? Or
No, I'm here for the bad boy.
Yeah, exactly. I was going to say that's
I only came here.
Wally
today.
is our resident bad boy. So.
Bad boy talk to me is like de la Bay talking about pipes, and so the bad boy provisions. The wonderful thing about real estate financing is that it is essentially non-recourse. So when your clients are asking you, what are they going to do to me and what can happen? And, if you're non-recourse, there's a lot less you care about. The worst that happens is you lose some property. Who cares about that? But the bad boy provision is a carve out from those non-recourse items. And that has to be, these provisions have to be read very closely and understood very carefully before clients are making decisions about how tough to be and how much pushback with their lenders. And the most you can hope for if you're in distress is that your bad boy provisions had been negotiated by Christy Mazzola or Tyler Vinyl, because then you'll probably be okay. But if they haven't been, you have to read them very carefully. And essentially, the bad boy provisions are divided into two parts. There's above the line provisions that where you're personally liable for specific losses relating to intentionally bad events. And below the line are items like voluntary bankruptcy or intentional assignments, unpermitted assignments that would trigger full recourse liability for the entire loan. So it's really important to know where you are in this and what potential personal liability you might have.
Yeah. And I think, we put foreclosure on here. I mean, that is a more difficult thing and expensive process. So it's always something can be threatened. It does happen, right? Lenders will move to foreclose on a property. But I think it's a nice segue to where we wanted to end today, which we can just jump to slide 24. It's bankruptcy, and no one wants to talk about bankruptcy. And obviously bankruptcy is almost never the preferred outcome for anybody. but it does always hang over the situation. And I think people need to understand what could happen inside of a bankruptcy if you ultimately get there. And in our experience, it's ultimately that threat, that hammer, where everybody could potentially lose inside of a bankruptcy process that can get you to that out of court deal. So understanding at a high level how it works and the tools that become available inside bankruptcy, I think actually facilitates the out of court solution that everybody's looking for. So what are some of those key tools? The automatic stay stops all lender actions. So if the lender was about to foreclose or sweep your cash or do the pledge trick that Steve was talking about, the automatic stay stops all that from happening. So it gives you some time. The board and management stay in control. So that's good. There's an opportunity sometimes to force a lender to accept a certain treatment as long as you have other creditors voting in favor of your Chapter 11 plan. For secure debt, you can sometimes bifurcate that if the value of the collateral is less the amount of the loan. So all of a sudden, a lender who thinks they have a fully secured claim and is going to get 100 cents on the dollar is going to realize that we're going to take the position the collateral is worth half their loan value and half their claim is just unsecured. Is going to get a very low recovery, right? And if you're able to pull that off, that can obviously help drive an out of court solution. There's even also the possibility sometimes if a lender doesn't want the collateral back, and there's some case law on bankruptcy, especially real estate bankruptcies, that would potentially allow you to force the lender to take the collateral in exchange for its claim. And so that obviously can be a threat that a lender, doesn't want to have to do that. You can say, well, I'm just going to go into bankruptcy and force you to do it. There's stuff about, also rejecting leases, which can be very helpful in the real estate context, or assigning them to someone else, even if it says, you're not allowed to do that outside of the bankruptcy context. And then there's various caps on damages that apply. So those are kind of the key, I think, tools you have. Steve, do you want to hit some of that?
Emphasize, I mean, listen, bankruptcy can be a great process. It could also be very value destructive and uncertain. But as George said, sometimes, unfortunately, to do an out of court solution, you have to be ready. You have to be be almost 95% of the way there to do a filing if you need to. We just learned, experience tells you that unless you have that threat and the company is prepared to do it, you don't have leverage with key constituents.
Yep. So let's go to the last slide. There's obviously a number of risks around bankruptcy, and we could spend an hour talking just about those. I think two big ones right at the top, right? Filing a bankruptcy can trigger the bad boy guarantee, as Wally noted, and so that can be very bad, right, for whoever provided that guarantee. And then it's expensive, right? So you need capital or cash on hand to really fund a bankruptcy process. If you don't have that, and you haven't started early enough to make sure you have that, then it might not even be an option on the table for you to use. There are various rights secured lenders have and will fight very hard for if you're in a fight with them. And any sort of fight like that or litigation in bankruptcy can also drain liquidity. And I think important for real estate is this concept of there's a special provision in the bankruptcy code for single asset real estate cases. And you can have a fight about whether you qualify as a single asset real estate debtor or not. And pre-planning can maybe help you avoid that categorization. If you are in that category, the time you have with the benefit of the automatic stay is significantly shorter. There's a test, but ballpark, you figure you only have 90 days to figure out a solution if you're a single asset real estate company. Whereas in a normal bankruptcy case, you can have upwards of 18 months to figure out a solution. So those are some limitations you need to explore and figure out. But I think the key takeaway is, spending some time and money on that up front, understanding if it's a realistic possibility or threat that you can use to leverage or increase the leverage of the company can help you get to consensual out-of-court resolution. So I don't know if anybody else had any other comments, but that was, I think we're out of time and was the end of our presentation. So thank you all for coming today.